Well, I guess we'll get started. First of all, on behalf of Americans for Financial Reform's Director, Lisa Donner, who's out of the state today, I'm Ed Merzwinski. I am U.S. PIRG Consumer Program Director, and I'm also coordinator of the AFR Task Force on the CFPB. And I also want to thank SEIU, a founding member of AFR. They were at the very first little meeting that we had and at all the subsequent meetings. And unions, civil rights groups, consumer groups, senior citizen groups, investor protection groups around the country and in Washington make up Americans for Financial Reform, the organization that worked with Professor Elizabeth Warren and Congressman Brad Miller, among others, to win Dodd-Frank Wall Street Reform and Consumer Protection Act's jewel, the Consumer Financial Protection Bureau. And Tuesday is the birthday, the fourth birthday of the CFPB, the fifth anniversary of the passage of the Dodd-Frank Act, and we're privileged today to have Director Richard Cordray of the CFPB, and after the director speaks, we will ask him some questions, and then we will have an announcement from CFPB on a new, well, it's an announcement, so I'm not going to give it away. And then we'll have a panel of AFR experts comment on the history of the CFPB. So Director Cordray, of course, was one of Professor Warren at the time, and then she became Special Assistant to the Treasury Secretary for the CFPB, Special Assistant to the President as well, was one of her first hires, and he was first Director of Enforcement after being the Ohio Attorney General, a job in which he did sort of the same thing the CFPB is doing, which is returning billions of dollars to consumers who had it stolen by banks, Wall Street banks in particular. So the CFPB has done a lot over the last 4 years. I'm not going to give away all of his thunder, but we are very appreciative of the CFPB. AFR was founded to establish strong Wall Street reform and the CFPB, and we've continued as a coalition to protect the CFPB because, as I often say, the idea of the CFPB needs no defense, only more defenders. And before Director Cordray speaks, I wanted to ask Marvin Silverfield, Director of AFR, to come up and present some words from some of our members around the country.
Thanks, Ed. Good afternoon, everyone. We all know that government agencies usually don't get much attention on their birthday, but the Consumer Financial Protection Bureau is unique. And we are excited today to be able to present a few comments from our members from around the country who we asked to join us in saying happy birthday to the CFPB. We were able to receive a little more than 800 comments thus far, and I want to share just a few this morning. This is one of the first ones here. We'll take a moment to read that. A government agency doing something positive for the people. Thank you, and take well-deserved pride in your work. Applause, applause. All right? Another one. I actually had occasion to use your services 2 years ago in a dispute with my lender. Just the mere mention of CFPB was enough for them to back off from trying to screw me. Kudos to you, and have a happy, happy birthday. Nice short one here. Americans need you. Don't give up. Not only here, thank you for protecting consumer rights, and please continue your good work. Too many regulatory oversight agencies get cozy with the entities they are policing to the point where they no longer honor their mission. The CFPB has remained true to its mission to protect consumers, and that's why we consumers have confidence in the CFPB. Please work to eliminate payday and other high-interest loans that keep poor people in an endless cycle of debt. One more. From the bottom of my heart, I thank you for standing up for the little guy. The individuals throughout this country that seldom have elsewhere to turn in the face of improper behavior by powerful corporations. Thank you for the work that you do. There's many more of these, and we look forward to presenting you in a few days.
And without further ado, I'd like to introduce Director Richard Cordray of the Consumer Financial Protection Bureau.
Thank you, Ed. I'm going to make a few remarks, I guess take a few questions, then I'm going to turn it over to the star of today's show, which is Darian Dorsey, who has been working on the announcement that we're putting out today and has been, as we were talking this morning, she's been with the consumer response team since 2010, right? You said fall, so you were there even before I was. That has been a tremendous and effective team, and I'm going to talk a little bit about their work, and then she's going to talk more about it. So thank you, Ed, for the kind introduction, for all you do. Thank you for the slideshow. We're going to look forward to seeing more of those. And thank you for all you do on behalf of consumers, Ed, through your roles with the Public Interest Research Group. You gave us yet another report today, indefatigable report writers, and for Americans for Financial Reform. I also want to thank the entire AFR coalition, as well as PIRG, the Consumer Federation of America, the Leadership Conference on Civil and Human Rights, Public Citizen, and the National Consumer Law Center for co-hosting this event. I'm aware that Aaron Kilroy played a key role in organizing today's event, so thank you, Aaron. And I'm especially pleased to be here at SEIU, which works so hard to put money in people's pockets, and I worked with them when I was in state government in Ohio, whereas we at the Consumer Bureau work just as hard to protect consumers so their money can stay in their pockets until they're ready to spend it. On behalf of the entire Consumer Financial Protection Bureau, I appreciate the invitation to celebrate our birthday with you. I know that in the last few years, the OCC has celebrated their 150th birthday. The Federal Reserve has celebrated their 100th birthday. We're 4, so we're young. Even in dog years, which is how the years we've been feeling, that's not very old. And it's impossible to keep from smiling to see so many of our friends in this room. We know very well how involved many of you were in the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act, a signal achievement, and the creation of the Consumer Bureau, which Ed so generously credited as being at the heart of that act for individual Americans. And while she could not be here with us today, I especially want to recognize Lisa Donner for her efforts, her persistent and cheerful efforts to lead such a large, diverse coalition of stakeholders, both then and now. Not only was it critical then for creating the passage of the law, but it's been critical now for keeping a unified consumer perspective on our work, one that consistently encourages the Bureau to fulfill both the spirit and the mandate of Congress through the Dodd-Frank Act. So let me take just a moment and comment on what is the foundation of our close friendship between the CFPB and AFR. Some of it is just the deep bond you build from sticking it out with each other through thick and thin. We have certainly done that. Some of it reflects the experience of being sharpened on the whetstone together and finding that each of us is tried and true, and I believe we have found that as well. But I like to think the core of our friendship stems from striving always to think together, carefully and honestly, about what steps we can take to help improve the everyday lives of consumers who struggle mightily with issues of household finances. To adapt a phrase from Abraham Lincoln, we must continue our work in the financial marketplace to see not that might makes right, but that right makes might. The basic premise of the unfettered free market is that the discipline of the market is sufficient to assure that consumers are treated fairly. Having lived through the financial crisis, we cannot easily accept that approach as the be-all and the end-all. We do care deeply about how things come out for consumers, and we've seen that they do not always come out well. And when the economy goes off the rails, the damage done to people's lives can be severe and lasting. We're still feeling that in our society today. Many people are simply victims of circumstance, such as young people who graduated from college at the wrong time into a busted economy, or families whose homes ended up deeply underwater because of foreclosures down the street. So we have hard and important work to do. At the same time, we include you among our true friends because you give us your honest perspective on what we're doing and how we're doing it. And that is so immensely valuable to us, has been every day that we've been in existence. There's been a debate of long standing over Stephen Decatur's famous statement, "My country, right or wrong?" If we tried to prevail upon you to have such blind faith in us, this agency, right or wrong, I do not think you would or should do so. Instead, I think we would finally agree on the more noble formulation by Senator Carl Schurz, who restated the point a half-century later as follows: "My country, right or wrong? If right, to be kept right. If wrong, to be set right." That's the path that you and we have chosen for ourselves, and it's a happy path for us to travel together. So much then for philosophy. Now on to our birthday cake. Next week marks 5 years since passage of the Dodd-Frank Act and 4 years since the Consumer Bureau opened its doors. As you well know, and with quite a bit of input from many of you in this room, Congress created this agency in response to the financial crisis with the purpose and sole focus of protecting consumers in the financial marketplace. We understand our responsibility to stand on the side of consumers and ensure that they're treated fairly. Through fair rules, consistent oversight, appropriate enforcement of the law, and broad-based consumer engagement, the Consumer Bureau is working to restore people's trust and confidence in the markets they use for everyday financial products and services. In a very short time, we've done new and important work. We've begun to supervise markets that have never had direct supervision before at the federal level, including student loan servicing, credit reporting, and debt collection. We've also written mortgage origination rules to help ensure that consumers can afford to repay their loans without being set up to fail, and mortgage servicing rules that help end surprises and runarounds for consumers who bought a home. We've written rules to provide new consumer protections for remittance transfers, and we're working on rules that would provide new consumer protections for prepaid cards and prepaid accounts, as well as payday loans, debt collection, and arbitration agreements. We're providing expanded access to financial education in the classroom, in the workplace, in libraries and social service agencies, for service members and veterans, for older Americans, for the many underserved consumers, and for all consumers generally. To date, the Bureau's enforcement activity has secured more than $10 billion in relief to more than 17 million consumers. In the past year alone, we've rounded up key partners to join us in this work and achieve more together than any of us could have achieved by ourselves. For example, together with the Office of the Comptroller of the Currency and 47 state attorneys general, we just took action against JPMorgan Chase to overhaul its debt collection and debt sales practices and provide debt relief to more than 500,000 consumers. We recently worked with the Department of Education to obtain $480 million in debt relief to student loan borrowers who were wronged by Corinthian Colleges, a for-profit chain of colleges that allegedly violated the law and has since declared bankruptcy. And we joined the FCC in several states to take action against Verizon and Sprint, which resulted in more than $100 million in consumer redress and new systemic changes to prevent mobile cramming of unexpected and unjustified charges onto consumer cell phone bills. Let me focus more specifically, however, on another key element of our work. When the Consumer Bureau opened its doors, one of the first things we did was begin to accept consumer complaints. Hearing directly from consumers in their own words about their problems with financial products and services is fundamental to our mission. It gives us a true compass in real time about the issues and problems that individual consumers find themselves dealing with in their financial lives. It has, in fact, turned out to be foundational to all our work. In our first month, we handled fewer than 1,000 credit card complaints. Since then, we've expanded our menu to all manner of complaints about financial products and services, including mortgages, credit cards, auto loans, student loans, deposit accounts, debt collection, credit reporting, payday loans, consumer loans, and more. As of this month, we've now handled over 650,000 consumer complaints. From this wealth of information, we have identified, categorized, analyzed, and synthesized what we have heard. We've quantified how many of these complaints involve mortgages or credit cards or debt collection, and the specific types of complaints that consumers have about these and other products. We've tracked the timeframes for company responses, and we've specified how many complaints involve different kinds of relief. Since June of 2012, we built a public consumer complaint database and shared individual-level complaint data on our website to educate the public and improve the functioning of the marketplace, a first by any financial regulator at the state or federal level. To add to the valuable complaint information already available to the public, just a few months ago, we started allowing consumers to share their specific account of what happened in their own words so that others may read about and better understand their experiences. A consumer who chooses to make her experience public enables more people to exert their power to improve the financial marketplace. So publishing these complaint narratives represents a milestone for consumer empowerment. They are the heart and soul of a consumer complaint. We will now be adding to that work by inaugurating a new regular monthly feature. Starting today, we will be sharing a summary of our consumer complaints every month. Our new monthly reports will include complaint data on company performance, complaint volume, state and local information, and product trends. The reports provide a high-level snapshot of trends and analyses found in the consumer complaints we receive. They can be used to inform the public, the industry, researchers, reporters, and everyone interested in the financial marketplace. Notably, these monthly reports will include information about a new category in the lexicon of consumer finance, what we call the, quote, most complained about companies. For example, the 3 most complained about companies in this report are Equifax, Experian, and Bank of America. Keep in mind that these are also some of the largest companies in this arena that deal with many millions of consumers, so the data needs to be viewed in context. In fact, we're working on how we can best try to normalize complaint data for size and volume, among other things. The reports also will have information about whether the volume of complaints are up, down, or unchanged for that particular company from the same time last year. In addition to informing and prioritizing our work at the Bureau, we believe these analyses can help the industry identify specific areas for improvement. Indeed, our database is a very effective source of information for an institution to get a sense of what complaints are being made about their competitors, and hence what kinds of problems they can work proactively to prevent or avoid in those markets. Thus, these metrics can help push companies to compete with themselves and with one another to improve their customer service, which will boost their own reputations and foster greater trust in the marketplace. The monthly reports will also include information about complaint volume and product trends, such as which products are bringing in the most complaints. And finally, the complaint information will be broken down state by state so that state officials, local consumer groups, and others can parse the information to find out what is happening in their part of the country. We also intend to shine a geographic spotlight on the voices and messages from consumers in a particular area of the country. In this first monthly report, the focus is on Milwaukee, Wisconsin, where we recently held a field hearing. This example is also meant to spur people into creating their own localized reports and seeing for themselves what consumers in their own areas are saying about the financial marketplace. Each monthly report will also spotlight a particular product to provide more in-depth coverage of findings and trends. For this inaugural report, we chose to spotlight debt collection, given the large volume of complaints we continue to handle each month about this product. Each complaint that people take time to submit to the Consumer Bureau can provide invaluable information and insight. Consumer complaint data is part of our DNA, and these complaints play an important role in our supervision of companies, our enforcement actions, our rulemakings, and our engagement with service members, students, the economically vulnerable, and older Americans. Each complaint is a chance for us to evaluate a perceived problem and see if it can be addressed successfully. But more importantly, complaints make all the difference by informing our work and helping us identify and prioritize problems. We know that if we hear about the same problem from 50 consumers, it likely looms larger than if we hear about it only from 1 or 2. All of these complaints have real people behind them. Each tells us a story about how consumers view their experiences with financial institutions as they struggle to manage the ways and means of their economic lives. Often consumers ask simply to be treated with fairness, dignity, and respect. And we all know in our hearts this is exactly what we all deserve. For example, being on the hook for a debt you do not owe is stressful and can be scary. If you do not know where to turn, you might feel hopeless. We heard from William, who was receiving calls for a debt he did not owe, one of millions of Americans who suffer that problem. William told us he tried to resolve the issue for more than 4 years and saw his credit being ruined in the process. He said, "None of them could do anything except tell me I had to pay them the $8,500. But because he submitted a complaint to us, he was able to end the prolonged standoff in just 1 week." As William told us, just to have the situation resolved, that just felt good. In a situation for me that was seemingly endless and hopeless, the CFPB helped me to find resolution. It's a new day. Every success of this kind is a thrill for us. One consumer tagged her story about the relief she and her husband got from our handling of a mortgage complaint with the theme from Mighty Mouse. Those older people in the room. Here they come to save the day. We all got a good laugh out of that one, but it was poignant because apparently it was exactly how she felt. As our complaint data is made available to the public regularly through these monthly reports, companies will have more incentive to address potential shortcomings in their businesses that are harming consumers. This should encourage companies to improve the overall quality of their products and compete more vigorously over good customer service. We are already seeing this happen. In the credit card market, for example, the J.D. Power surveys are showing consistent improvement in customer satisfaction with their credit card issuers. There are 3 reasons for that, in my view. The important reforms made by the Card Act, first. Second, the focus that consumers themselves have put on paying down credit card debt since the financial crisis. And third, the changes that companies have made in their customer service. It's that third point I would focus on here, how certain companies are demonstrating their ability to up their game by consciously improving their customer service. In particular, the use of the Net Promoter Score approach to handling complaint calls in the credit card market has done wonders for customer satisfaction, has created more trust and confidence in those financial providers. So that is a sensible and meaningful best practice. I would urge all financial institutions to adopt that same approach across all of their product lines and financially incentivize those who directly handle complaints not to rush people off the phone, but to focus on and carry out this more productive approach. At the same time, our approach to consumer complaints can work in tandem to help companies reduce compliance risk, reduce litigation risk, and reduce reputational risk. It can and will help financial institutions attract, retain, and grow their customer base to expand their business in a more consumer-friendly manner. If we can help spur competition based on consumer satisfaction, this has the potential to improve the functioning, transparency, and efficiency of the financial marketplace. We have seen how PERG and others are already beginning to scorecard companies based on this data, and we want to encourage more of that. You can help us by seeing that these things happen more routinely and more consistently for the benefit of consumers. Everyone comes to understand from their own experiences how issues of consumer finance deeply affect their lives. All the ways we deal with money, and all the ways we may need to borrow money to create opportunities for ourselves, to go to school, to buy a car, to buy a home, to start a business, are fundamental to our chances in life. Student loans, auto loans, mortgages, credit cards, bank accounts, and other financial products can help people achieve their goals. But we've also seen these products can pose risks that may undermine or even destroy people's deepest aspirations. At the Consumer Bureau, we're guided in all our work by our mission statement and our vision statement, which we worked with now Senator Elizabeth Warren to put together in our formative early days. We aim to be, and I quote, a 21st century agency that helps consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. Our vision statement, which I also will quote, foresees a consumer financial marketplace where customers can see prices and risks up front and where they can easily make product comparisons, in which no one can build a business model around unfair, deceptive, or abusive practices, and that works for American consumers, responsible providers, and the economy as a whole. These are high standards to live up to, and we know that, try as we might, we will never manage to live up to them fully. But the aspiration to be better and to do the right thing as best we can discern it continues to motivate and inspire us each and every day. Thank you for all of your welcome efforts to help us make it so. Thank you.
Thanks very much, Rich. And by the way, people who might have seen me, I was not checking my email. I was tweeting out the announcement in real time. Thank you very much.
I thought you were working on your next report.
Yeah. By the way, I'll just present you, Director Cordray, with a copy of PERG's latest report on the database. And I want to say we have a number of recommendations in the report, and one of them is that the database is great. It's great that you've added narratives, but you should add monthly snapshots and monthly dashboards. So you've accomplished another one of our recommendations, so thank you very much. I'd like to ask you a couple of brief questions before we get to Darian. What do you see as the CFPB's greatest accomplishment since opening its doors?
So which child is my favorite? Is that what you're asking? I'll say a couple things. One is just to reinforce what we're talking about today, which is our consumer response function. The team that built this from scratch, in the face of a lot of uncertainty about what the volume would be, how it would work, a lot of risk involved, have just done, in my view, a tremendous job. And over time, we have learned, many of us at the Bureau, more and more, just how important this is to the work we're doing. I talked a moment ago about how it can provide a different pressure on the marketplace that offsets some of the shareholder pressure for companies just to make money no matter how they might make it. And I think that that's significant. I also think that for consumers who don't really have much place that they can turn when they have an individual dispute that isn't necessarily worth a lot of money, sometimes it is, sometimes it isn't, but deals with dignity and fairness and respect. there were years ago that small claims court was supposed to be the answer for these people, but it's never really worked, and people aren't going to hire a lawyer and go to court. This provides a way for them to try to get relief and to know that somebody is willing to work with them and help them, and I think that that's been quite important. And finally, I would say within the Bureau that the voice of the consumer comes directly to us on a daily basis and informs our work is quite important. It gives me a lot of confidence that in the future, the agency will not be susceptible to capture because the voice of the consumer is loudly and insistently drumming into our ears every day, and that's quite important. I would also mention that the mortgage rules that we put together, which was a very first major task for the Bureau, was a significant achievement. People worked incredibly hard on that. There were really unrealistic deadlines Congress had set when you really thought about the amount of work that we were doing. And those are key protections that we put in place while also working hard with industry to make sure they were implemented successfully. And I think that's been a model for how we approach our rulemaking function across the Bureau. But the interesting thing is some of these things that we do, consumers may never really know about or understand. I mean, if we help fix problems in the mortgage market, that will benefit people enormously across the country. They may not ever realize it happened or that the CFPB did it. The consumer response quite significantly only works if people are actively participating and taking part. And so that's something I want to continue to encourage more of from the American consumer across the country.
Thank you for that. What do you see as priorities for the year ahead?
Well, we continue to have an awful lot of work to do. It's getting a little easier. People wouldn't say it's easy at the Bureau because we have ramped up to become a bigger agency, more fully staffed, more closer to steady state. All of the things that I've emphasized, including regulatory enforcement, supervision work, the consumer engagement and consumer educational work, the consumer response work, all the elements of building an agency that we did very fast and faster than we would have liked in certain respects, and we've not been perfect. I'd be the first to say that. But we always try to improve, and that's a key thing for us. In the regulatory arena in particular, because people often focus on that, we are working to finalize rules to provide consumer protections on prepaid cards and prepaid accounts. We're working to finalize new rules on the Home Mortgage Disclosure Act, the HMDA reporting, and not only rules, but we're overhauling the technology, which will come to us from the Federal Reserve, and I think you will find it will be more user-friendly, just more modern in various respects, and therefore really facilitate the purposes of that statute. We are underway, as you know, on rules affecting small dollar loans, payday loans, car title loans, certain installment loans. I actually announced yesterday that we will be moving forward with rulemaking on arbitration agreements, which I guess was news. And that's something that will be very much on our plate. And we also have indicated we're working on new rules for the debt collection market, which is a very troubled market, as we all know, and has not been really overhauled for almost 40 years. So there's much to do there. And overdraft on deposit accounts. So as usual at the Bureau, full plate, more hands on deck to do that work, but at the same time, just so much needs to be done to help consumers have a fair fight out there in the financial marketplace.
Great. And what do you see as your greatest challenges, as a final question?
To me, it's always getting a good amount of productive work done in a reasonable amount of time. That's always a challenge. It's something we fight every day at the Bureau. And we have our detractors and opponents and people who would love to slow us down or to hamstring us in various ways. You have always had our back, and that has been crucial. I mean, it's not just that AFR helped work to accomplish a new consumer finance agency, but has worked to protect and defend and give us the ability to move forward and do our work. That remains important. And I would say that the other thing that I would really like is I'd love to know that 320 million Americans are engaged as consumers with this agency, and it takes time to do that. But everything you can do to help promote the use of our tools, the tools people can use to help themselves figure out how best to go about buying a home or paying for college, or eventually we'll have one on buying a car, retirement choices. Getting people to use our consumer complaint line so that when they have a complaint or a problem, they don't just swallow it, as most people do, or grouse about it to those in their immediate hearing, but they actually give it to us so that we can understand and learn from it and have a chance to do something about it. I still feel that although the volume is much higher than it was at the outset, it would be higher still if there were more awareness of people that was an avenue. So everything you can do to help us on those fronts, and what you do every day to give us your best advice, to give us your best thinking, to try to, we don't always agree, but we know that we have the same goals and outlook in mind, which is improving life for everyday consumers. That helps us immensely. Please keep doing that.
Well, could we have a hand for Director Cordray and the CFPB? And we're not taking a break here, so we're going right into our feature presentation. Darian Dorsey is Chief of Staff of the Consumer Response Unit. As Director Cordray said, she's been with the Bureau since 2010, and she is going to drill down a little bit more into the exciting announcement today.
Thank you, and thank you for having us here today. We're really excited to talk about the monthly complaint report. I'm going to spend just a couple of minutes whetting your appetite for actually reading it. It's just a short kind of 28 pages, but there's a lot of information packed in here, and so talk a little bit about that today. So what is the monthly complaint report? We know it's a recommendation that we should have such a thing, and really kind of circling back to the director's remarks, consumer complaints are really an integral part of the work that we do at the Consumer Financial Protection Bureau, and we think that this information can be really helpful. We've done that with the database. And our office really hears directly from consumers about the challenges they're facing in the marketplace, bringing their concerns to the attention of companies, and then trying to help address those complaints. This monthly complaint report provides just a high-level snapshot of trends in consumer complaints, so kind of in between the complaint database, which gives you very granular information, and kind of waiting for our annual reports. This is really intended to be some timely trend information. So what's in this monthly complaint report, so you can all get excited about it? First, we have a section on complaint volume, a product spotlight, and a geographic spotlight that the director alluded to. Within the complaint volume, we have breakdowns by product, by state, and by company. Within the product spotlight, we break down the type, so the issue, what the consumer was complaining about, and also within the product, look at variations by state and then also at companies, so that most complained about concept appears there as well. And then we include a geographic spotlight each month that focuses on product distributions, looks at changes over time, as well as looks at companies. So how do the most complained about companies vary in one locality versus another, versus the kind of nationwide picture. And then lastly, we included a few items in the appendix for complaints by month, by product, so you can kind of slice and dice in other ways, or if you're particularly interested in an area and want to know what those numbers are. And then also complaints by locality and product, so that includes states and then a few other territories. So just a little bit, because I know there are a lot of data kindred spirits in the room that care about the methodology and kind of how this works. One of the things that we were very mindful of in this process was making sure we're making meaningful comparisons. That was really important to us. And to that end, we've used two methods in the report that I'll touch on here. One is we've used 3-month rolling averages to account for monthly and seasonal fluctuations. So we know that these are going to happen, and we want to make sure that we account for those, and that the changes you see are meaningful changes. So we, throughout the report, compare the current 3-month average to the same period in the prior year. So in this report, that means comparing April, May, and June of 2014 to April, May, and June of 2015. So looking at those rolling averages for those periods. And then for company level data, this information lags by 2 months and covers a slightly different time period. to ensure that it reflects the 60 days that companies have to respond to complaints. So this means that it reflects what's in the consumer complaint database. So these are complaints that have been sent to companies for response and to which they've had the opportunity to confirm the commercial relationship or let us know if they cannot. So this is an important kind of piece that we built in, that 2-month lag. So again, that would be February, March, and April 2014 to February, March, and April 2015 for this report. And then lastly, we do include some month-to-month comparisons to highlight more immediate trends. So in some products, there's a reason. There is a seasonality, and we didn't want to completely obscure seasonality. So there are a few areas in the report where we include month-to-month comparisons. So I'll touch on a little bit of what's in there. I'm just going to touch on 3 or 4 things. But this is a table you'll find in the report that talks about how are the distributions of complaints by product changing. So looking at the 3-month rolling average from this year and last year, and seeing for those 650,000 complaints we received total, including what we received just last month, and it's 23,000. This is giving you a sense of what's kind of in there and what's changing as the number of complaints ticks up each month. And what you can see is that for consumer loans, we have seen a 55% increase from the same time last year in consumer loan complaints. And similarly, we've seen increases in credit reporting, payday loans, student loans, credit card, money transfers, a small increase with mortgage. And then, always wanting to include what may be kind of good news is seeing some declines in other areas. And so debt collection and bank accounts and services complaints are down slightly from the same time last year. So what you'll see in the report is that debt collection, mortgage, and credit reporting continue to round out the top 3 most complained about products that we receive complaints about each month. And for the 22nd consecutive month, so we've been taking debt collection complaints since July of 2013. For the 22nd consecutive month, debt collection is the most complained about product that we receive. And just last month, that meant the debt collection complaints represented almost a third, so 32% of all the complaints we received in June were debt collection complaints. Looking at month to month, and a couple of those highlights, bank account and services complaints showed the greatest month-over-month percentage increase. So you see that's a 17% uptick month-over-month, where student loans, we saw the greatest month-over-month decrease at 4%, so a slight decline there. So the complaint volume by company that I mentioned already built in the 2-month lag, this is one of the graphs you'll find in the report. These are the top 10 most complained about companies for the period of February, March, and April of 2015. So as the director mentioned in his remarks, Equifax, Experian, and Bank of America are the top 3 most complained about companies. Obviously, it's important to consider that in context of their size and other information, but it is nonetheless important information to know where we're getting complaints and about which companies. And what we include in this graph as well is information about which products we're seeing complaints about for these individual companies. So you have a little bit of a sense. Not surprisingly, Equifax and Experian pretty much have a solid green bar for credit reporting. But in other areas, you can see it's more of a mix of products that we receive complaints about for those companies. And this is the kind of table that sort of backs up that graphical information, where you can actually see what was the 3-month average for these top 10 companies, what was the percentage change from last year, what is the monthly average over time, so since we've been taking complaints, what's the monthly average, and then also the total complaints. So you can actually see not only are these the most complained about in the last 3 years, but you can get just kind of a order of magnitude sense of how many complaints we're receiving about these companies. So the Bureau, for example, has handled nearly 20,000 complaints about Equifax in under 4 years. Another more than 20,000 about Experian. And then lastly, nearly 48,000 complaints about Bank of America. So that kind of gives you a sense of we've been busy. Lastly, I just want to make sure you know exactly where to find these things and also have the opportunity to be able to do your own work and take a look at the issues that are really important to you. So consumerfinance.gov/reports. I'm told that report is actually live right now. So you can check it out, download it, and share it widely. And then consumerfinance.gov/complaint database, where you can actually read more than 10,000, last time I checked a day or so ago, consumers' narratives in their own words to give even more context to the information we've touched on in the report.
I'm so shocked to see that my two favorite credit bureaus are number 1 and 2 on the list. I've been fighting the credit bureau wars for 25 years, and I really think the most important thing Congress did was to create the CFPB, which has the tools to go after them. It's now my privilege to introduce Nancy Zurkin, Vice President of the Leadership Conference on Civil and Human Rights, who will introduce the expert panel from AFR members, which is the remainder of our program today. So Nancy's working her way forward. Do we need to take a break? Do we have time to take a break, or should we just start right away? We ask Aaron everything. All right. Do we want to take a 5-minute break? Then we'll only have 40 minutes for your panel. It's up to the group. We'll move on. We'll keep rolling.
Just have an extra 5 minutes.
We'll keep
Everybody can
rolling.
get back to their
So
offices.
does the panel want to come up and take their seats? You know who you are?
Right. Okay. I think we're ready for prime time. Maybe, let me first identify my fellow panelists. And I'm very happy to be here with all of them today. Lauren Sanders, Managing Attorney and Associate Director of the National Consumer Law Center. Mike Calhoun, President of the Center for Responsible Lending. Pam Banks, Senior Policy Counsel at Consumers Union. And Ruth Susswein at Consumer Action. I'm just going to make a few remarks and then throw it open to the panel. As Ed said, I'm Nancy Zurkin, Executive Vice President of the Leadership Conference on Civil and Human Rights. And I'm pleased to begin today's conversation on the important work that the Consumer Bureau has undertaken so far and on the important role moving forward. To set the stage for this conversation, let's step back a few years and recall what Americans, especially in the communities of color, were facing before the passage of Dodd-Frank. In 2007, the Wall Street Journal found that more than half, 55% to be exact, of securitized subprime mortgages went to borrowers who could have qualified for conventional, more affordable loans. Several other studies found that African Americans and Latino borrowers were more likely than non-minority borrowers with the same credit profile to be steered into these loans. Also in 2007, still a year before the worst of the financial crisis, the Center for Responsible Lending predicted, and we all thought, oh my goodness, this is awful, that 2.4 million subprime borrowers would ultimately wind up in foreclosure. While some people in the industry and on Capitol Hill accuse CRL of hyping the crisis and, quote, betting against housing, the reality that happened was even worse than what CRL had initially predicted, when many of our nation's biggest banks and Fannie and Freddie went on life support, and the economy slid into the Great Recession. Needless to say, the impact of these foreclosures was disproportionately high on communities of color. While almost 4.5% of white borrowers face foreclosure, Black and Latino homeowners had 7.9 and 7.7 respectively in foreclosure rates, meaning that Blacks and Latinos were 70% more likely to face foreclosures. At the same time, consumers had to contend with its deceptive and abusive practices in other areas. For example, many banks would reorder debit card transaction in order to trigger overdraft fees. And while the Military Lending Act of 2007 eliminated payday lending to service members, overall, the payday lending industry continued to grow. And to make matters worse, just several years earlier, Congress had changed the bankruptcy laws, which many of us were involved in, to make it much harder for borrowers who were drowning in debt to actually get a fresh start. I could go on and on. It was a period of time that there really was not a watchdog. And standing here today, 5 years later, it is so gratifying hearing all of the things that CFPB has done. The financial reform, AFR started organizing support for reform for what eventually became Dodd-Frank. And the Leadership Conference was very glad to be a part of the effort, especially to fulfill an idea of then Professor Elizabeth Warren, which was to create a new agency that would defend consumers who didn't have a real voice in Congress or with the regulators. So my question for the panel today is, 5 years later, what has changed? I'm going to go right down unless there was a different order that I didn't know about. Lauren?
Am I on? Okay, great. Thank you. Well, that's a tall task in a very small number of minutes, especially since I have three topics: prepaid cards, debt collection, and arbitration. So starting with prepaid cards, it's a rapidly growing market, providing an alternative transaction account to consumers who have been shut out of the financial mainstream, been burned by overdraft fees, just looking for a safer, better way to control their money. Employers use them to pay workers as well. Unfortunately, a lot of prepaid cards really lack really basic protections, the ones that you have for your debit card, to the right to dispute unauthorized charges. Often they are loaded with fees that people don't understand for things as basic as checking your balance. And a small number of them, and most prepaid cards are indeed prepaid. A very small number even have overdraft fees. And in fact, a report that we released this week showed that those cards with overdraft fees are heavily found at payday lenders. What a surprise. Cards that are specially designed to allow the payday lender to reach in and grab that paycheck and maybe overdraft at the same time, increasing the cost of a loan. So the CFPB has tackled new protections for this market that did not exist before. They've proposed quite detailed, comprehensive rules to really improve the protections for prepaid cards, to give consumers dispute rights in case there are errors or unauthorized charges, clear fee information, and a lot of reforms to curtail the abuses of overdraft fees and linked credit forms on prepaid cards. We're looking forward to those rules being finalized. Hope they might be strengthened just a bit to completely ban overdraft fees and to prevent all predatory lenders from linking their products to prepaid cards. Debt collection. We heard a lot about debt collection already. The number one complaint at the CFPB, even though they haven't been collecting complaints that long, 30 million consumers across this nation have debts in collection. The FTC has been going after debt collectors for nearly 40 years, continues to be a really important partner in bringing enforcement actions. But the CFPB has really important new tools that did not exist 5 years ago to address really rampant problems in the debt collection market. The CFPB can go after not only third-party debt collectors, but also the first-party companies when they collect their own debts. So the CFPB has brought important enforcement actions against abusive debt collection practices by payday lenders, military-based retailers, for-profit schools, and buy here, pay here auto dealers. That was authority that didn't exist before. In addition to enforcement actions, the CFPB has new authority to go in and examine the larger debt collectors, to go in, listen to their phone calls to collectors, examine their books and records, find out what's really going on, and take action if they spot a problem. And although the supervision process is not entirely public, they have given us some indication of the problems that they have found and addressed, including collectors that have made excessive and inconvenient telephone calls to harass consumers, and at least one collector that had a habit of filing lawsuits against consumers, but if the consumer merely showed up in court, 70% of those complaints were dismissed because they didn't have the evidence to back up the lawsuit. The CFPB also has new authority to issue rules to implement the Fair Debt Collection Practices Act and to extend those rules to first-party creditors. That authority did not exist before. The CFPB has already embarked on a request for comments about what it ought to do in this area and is poised to really update rules that are 40 years old and address new problems. We expect them to address new problems like communications involving technologies that didn't exist 40 years ago, cell phones, email, social media, voicemail. We hope that they will take a lot of action to address old problems that are unfortunately way too rampant: excessive phone calls, harassment, threats. We'd like to see a limit of 3 calls per week. It seems like more than enough. We'd like to see consumers be able to simply say to the collector on the phone, orally, "Stop calling me," and not have to take the time to put it in writing. We hope the CFPB will tackle the new problems of the debt buyer industry that didn't exist, to make sure that when debts are passed on, you've got the right person and the right amount. The consumer doesn't have to start all over again. And we'd like to see a ban on collection of zombie debt that is just simply too old to accurately and fairly collect. Finally, arbitration. CFPB is writing a lot of great new rules, it has a lot of tools to protect consumers, but they can't do it all. They can't go after every violation out there. Consumers need the ability to protect themselves. And unfortunately, forced arbitration clauses in consumer contracts really serve as a get-out-of-jail-free card for companies who violate the law and prevent consumers from having their day of court. And we are really thrilled that the CFPB has the authority to limit or hopefully prohibit forced arbitration clauses in consumer contracts. They've begun the process by issuing a report on what they found in the arbitration market. And arbitration clauses, of course, also operate together with class action bans to prevent a court or even the arbitrator from ordering a company that has violated the law from redressing problems suffered by all consumers. So the CFPB's report on arbitration practices has found that arbitration agreements do limit relief to consumers, as we have always contended. A lot of these cases simply seem to just go away. The CFPB, after extensive research, found only 600 consumer arbitration cases over a number of years and about $400,000 in total relief for consumers. Over the same period, the CFPB found that cash payments to members of class actions were at least $1.1 billion and covered 34 million consumers. Clearly a much more effective way of getting relief to people. Arbitration clauses, like one industry webinar boasted, are a silver bullet for defeating claims in their entirety. CFPB also found that arbitration doesn't make products more affordable by comparing our credit card companies that had them and did not. So we look forward to a proposed rule on arbitration that will hopefully prohibit arbitration clauses and forced arbitration clauses in consumer contracts. Thank you.
Well, I think we're going to quickly demonstrate a little bit of the breadth of work that CFPB has on its plate. So I likewise will go quickly. And I want to start first with the mortgage rules. And it was appropriate, I think, in many ways, those were the first major rulemaking of the CFPB because of their impact on families' finances and their role in the financial crisis. And it was interesting with the mortgage rules because it's a pattern that we see, I think, in a lot of the rules that Nancy alluded to when we, and as many in this room, fought against the abuses in the subprime industry going back to 2000 and before. And we keep hearing this same pattern of responses from industry. The first was, there are no problems at all in this industry, just anecdotal evidence. And then the next would be sort of insult to injury. Well, you're going to hurt the very people you're trying to help. Although we knew in subprime lending that they were mainly targeted to existing homeowners, and about 1 in 4 people who took out those loans ended up losing their homes. So that was a little hard to take. Then the next is, if you adopt rules, it'll crash the markets. Nobody will be able to get a mortgage. We kind of disproved that with the 20 or so states that passed state mortgage protections. And then when the rule goes in and none of that happens, they just sort of move on and pretend none of it happens. And I think we've seen that with the mortgage rules here. At first there was no real need to do this, and the main concern was we're going to be swamped with litigation that's going to shut down the whole mortgage market. But the CFPB did an incredible job of finding a balanced approach for the ability to repay, came up with a rule that provided very substantial protections. But have you heard about any of these waves of lawsuits? I continually ask lenders at conferences to just give me one. Not, they may not know of all the thousands of them, and not a single one of them has yet come up with the one lawsuit, which you would kind of think if they were epidemic, they'd be able to find those. They also carved out 2 tiers of protections for small banks, and they currently have rules to expand that. And privately, many in the industry will openly will tell you we have a safer, better mortgage market system than we had before. It's better for consumers and actually better for lenders. We hope to bring those same types of reforms and are hearing those same arguments in the payday and small loan market where the CFPB is engaged in rulemaking. I think the important thing here is the CFPB has demonstrated just how data-driven they are. They have collected more data than all the previous studies put together, probably many-fold. And some of the things they've shown have provided even more evidence of what a debt trap and an abusive product the current model payday lending is. Their study found that, for example, over half the fees were being paid by borrowers who in a 12-month period were getting 10 or more loans without a break, hardly a once-in-a-blue-moon emergency service. They also, and I think this is important, as part of that rule, are addressing the car title industry, which sometimes gets overlooked, but is quickly trying to eclipse the payday industry. And in some ways, we call it payday lending on steroids because they can crash a family even faster in that they can immediately take your car. That's what they take a car title as security for these loans. And for most people, that totally shuts down their family. You can't get to work, can't get your kids to school. And many of them advertise and put in their public filings, such as with the SEC, that they base the lending solely on the amount of the value of the car, often and most often structured as a balloon payment that is often half or more and sometimes more than the person's paycheck that they're supposed to repay this loan with. So not surprisingly, you see the same thing of these loans flipped over and over again with lots of harm to the borrowers. And then this rule also covers and has to cover, as proposed, installment lending. I think probably a number of you heard me raise the example of just how extreme this can be, and our good friend Jim Carr put this in a piece that appeared in Forbes. ProPublico did a survey and a series of reports on these small lenders, and some of the examples are, you just can't believe that is possible. And in fact, they had judges who were hearing these cases who said the same, this can't be legal. So just one example they cite, a woman goes in for sort of a payday alternative loan, 6-month loan for $1,000, 240% interest. No verification or determination of ability to repay. Person had very modest income, under $2,000 a month. They fell behind, and a year later, the company sues. And remember, 240% interest is bouncing along all this time. So by the time they add attorney's fees, at the end of a year later, she's in the hole $4,000. So she starts making payments out of her monthly payments, and she was paying about $50 every month. They're getting $25 every time out of her paycheck and threatening her with garnishment. But again, remember, this interest is growing at 240% a month, which is a lot more than the payments. She's not even keeping up with the payments. By the time ProPublica chases her down, and she's between 4 and 5 years out from borrowing $1,000, she has paid back $5,000 plus. Her outstanding balance at that time is a little over $40,000. Her only risk that the lender has then is if she dies or files bankruptcy. And judges who were hearing initially were refusing to enter judgment on these. This is from Missouri. And then finally were persuaded that the law allowed this abuse. Let me go quickly to overdraft, which has some similarities here, where banks encourage high volumes of overdraft fees, reordering them. And again, we see low and moderate income houses and families of color hit particularly hard, with families getting hit with $500, $1,000, or even more in fees each year, and many of them being driven out of the banking system because it crashes their bank account, and then they're further in the fringe system. And you've often heard the story, the $40 cup of coffee. You go in and you overdraft, and that coffee at Starbucks suddenly is costing you $40. Well, sometimes the financial services industry really does outdo itself. Well, they decided they were missing revenue opportunities. So they've introduced a new variety of coffee, the $100 cup of coffee. So at a number of our leading banks, you go in and overdraft with your debit card, they hit you for a $35 fee. If you have not corrected the negative balance in 5 days, they hit you with a second $35 fee. And just for good measure, 5 days later, they hit you with another $35 fee. So by going over maybe $5 or $10 on this cup of coffee, you now owe $105 of fees. But they're sensitive to your plight, so they've put in limits on how many fees per day they will charge you for overdrafts. It's usually 4 to 5 fees per day is what they consider as the consumer protection there. Hopefully, the CFPB will provide significant changes in that market. And then finally, let me conclude by just reminding people of the importance of the UDAP authority. For me, I consider this as sort of the response to where does it say I can't do this rule? Or how do I get around this rule? Because continually we've seen this cat and mouse whack-a-mole game where regulators will rein in some ways, a practice. Our $100 cup of coffee is post, joint agency guidance on good practices in overdraft programs and the Fed's opt-in rule. These are the ways that industry has responded. And it is so critical to preserve that authority. And just finally, for all of us here, I think, speak for everyone, that the agency that we have, the CFPB, is one that we continue to fight hard for and that is worth fighting hard for. And likewise, its director, Rich Cordray, is a director who has been worth fighting hard for. Thank you.
Thank you, Mike. Pam Banks.
Good morning, and I have to start off by saying congratulations to Director Cordray. Congratulations to the CFPB. You are still here, and that is winning. Thank you. The CFPB, as you know, has made many strides in protecting consumers in the financial marketplace, from the creation of its consumer complaint database and the recent decision to include narratives in the database, and now today's announcement, which I can't wait to get back to the office to take a look at. One of the many issues that the CFPB has tackled that is of particular interest to Consumers Union is its work on credit reports. Many of you may know that for several years, we have had a campaign for accurate credit reports and to get consumers a free credit report with their annual free credit score with their annual free credit report. The good news is that in 2012, the CFPB announced that it would be supervising large credit reporting companies. It marked the first time these companies have been subject to federal oversight. The CFPB's focus has been on the accuracy, no surprise there, of the information received by their credit reporting agencies, their accuracy in assembling and maintaining the information, and the process that governs error resolution. And I can tell you, when we go out for a story ask with respect to credit report, our number one complaint is with respect to credit report accuracy. Their goal, and the goal of many of us here, is to make sure that the credit report market works better for consumers. And to that end, the CFPB has received and helped resolve over 31,000 consumer complaints since July 2011. And I'm sure when I look at the more recent data, there will be more. It has taken enforcement action against auto financing companies for distorting borrowers' credit reports. And to help consumers make well-informed financial decisions, the CFPB has made great strides in educating consumers about credit reports and how they are used in the marketplace, something that is sorely, sorely needed. Just recently, the CFPB issued a report that documented that over 26 million consumers are credit invisible. Credit invisible, that means they have no credit history. And as we know, a limited credit history can create real barriers for consumers looking to access credit needed for school, to buy a house, to start a business, anything imaginable in which you need credit. If you don't have a credit history, you are not likely to get the loan. These are just a few of the things that the CFPB has done to ensure that credit reports accurately reflect the consumer's true creditworthiness. And there's more good news with respect to credit scores. This year, thanks in large part to the CFPB, nonprofit counselors that purchase credit reports on behalf of their clients are now able to share those reports and credit scores with consumers. That's a big, big deal. And then last year, the CFPB launched an initiative calling on more credit card companies, issuers, to provide credit scores directly and freely to their consumers. And as you know, today several credit card companies provide free credit scores to their customers. Ideally, and there's always a but or ideally, we would love these scores to be available to all consumers across all product lines. With respect to medical debt, the CFPB issued a report that raised concerns about the system for incurring, collecting, and reporting medical debt, and the problems it creates for consumers. It noted that a significant portion of consumers with medical debt on their credit report show no evidence of financial distress and are consumers who generally pay their financial obligations on time. The medical debt that they may have probably is inaccurate. Or in the alternative, perhaps the insurance company has not paid. Medical debt is unexpected and unplanned. Consumers should not be penalized for getting sick. Again, thanks in part to the work of the CFPB in highlighting this issue, the industry is moving towards lessening the impact of medical debt on credit reports. Now the problem is to get creditors to request this particular score. But it's a big deal. It's a victory for us. Overall, the CFPB has done an outstanding job in making sure that credit reports are accurate and securing free credit scores for consumers. But, and as I mentioned earlier, there's always a but, problems still exist. We continue to hear from consumers about the difficulties they face when trying to correct their credit reports. For example, one consumer told us that her biggest complaint is, and I quote, that credit reporting companies offer no way to find out what information they have wrong, so I can't start the frustrating road to try to fix it. Also, consumers continue to tell us that they want free, reliable credit scores. Another consumer asked, why is my credit score, which these days is used for just about everything, not available with my annual free credit report from the bureaus? Shouldn't the score be under the same rules as the credit report? Seems logical to me. And consumers should be able to get that free score when they get their credit report. We will continue to work with the CFPB on this issue and other issues affecting consumers. And again, congratulations, and I'm glad you're still here.
Thank you, Pam. Ruth, and then after Ruth has gone, we ought to have time for at least a few questions.
We look at the great steps that the Bureau has taken in 4 short years and to empower individual consumers, and we see an exceptional consumer complaint system. We see the Bureau has taken its mandate very, very seriously. From the outset, the CFPB has understood the value of exposing complaints for all to see. And so, as the director has said, it created a public complaint database. It's a tool for consumers to use to protect themselves before they make an important financial decision. It's a place to report financial disputes in hopes of resolution. And it's a way to alert others to financial injustices, unfairness, and abusive behavior. Users can now search the Bureau's database by financial product, problem, company name, keyword. And just recently, as we heard just a little while ago, the Bureau took this bold step of including the guts of the complaint in the database, the details that express the actual problems that consumers suffer, the reasons why consumers were moved to complain. And despite serious industry opposition, consumers can now share their firsthand experiences in their own words to alert others and prevent further financial harm. We can now rely on the complaint details to judge whether a company is worth doing business with. Do they support customers? Do they resolve complaints? The Bureau recognizes this is the kind of information consumers need in order to arm themselves to make smart financial decisions. And industry needs to know that we are ready to use this tool. As Ed Mierzwinski would say, we're ready to name and shame. Great pains have been taken to protect consumers' personal information, when they choose to add their details to the database. And companies can also choose to publicly disagree with the complaint and add that to the database as well. Complaint narratives make the complaint come to life. While the Bureau has many tools, as we know, and we've heard a bunch of them today, the CFPB knows that publicly reporting complaint details is the first step toward combating bad practices. We may detect unfairness, discrimination in the marketplace, but this new tool helps make it very difficult for a company to belittle a consumer's complaint and write it off as merely anecdotal when scores of others are reporting the same kind of problem, and there it is for everyone to see in the database. The complaints, of course, also help the Bureau identify patterns and problems, as they've mentioned, and empower them to take action. The CFPB complaint system makes financial institutions more accountable. They must respond to these complaints, hopefully resolve them, and they need to evaluate the practices that have caused these problems. No company wants to be number one on that list that Darian just pointed out. In a few short years, the Bureau has thoughtfully, deliberately given consumers some critical tools to help protect themselves in the marketplace. There is some more work to be done, though. We must help the Bureau press financial firms to offer meaningful relief to consumer complaints. We must ensure that all complaints are included in the database and that the dispute portion of the complaint process is more effective. And we all have a responsibility, along with the Bureau, to ensure that consumers know about these valuable tools and know how to use them. We appreciate that the Bureau has always been open to input on these issues, and we look forward to working with the Bureau to continue to build on this remarkable record of consumer protection and empowerment. Thank you. Happy birthday.
And thank you all. We have time for a few questions. We are so happy to have Chair Cordray here, Director Cordray here. It is wonderful for me, who testified several times, as Mike did, on the agency, because it was the agency we were trying to do, to be here really 7 years later and see everything you all are doing. Questions? Yeah. Right there.
You assist to the director or to the panel?
Director.
Mike Calhoun, do you want to take that?
I'll just say quickly, I think what keeping on what role they play, which I think advances. The other is the role of testing, and I do think that remains a valuable tool. Obviously, like I said, issues that arise from doing it correctly, but virtually every time testing is done, it shows disparate treatment, identical folks coming in, applying for credit, trying to resolve problems with virtually every situation. I think particularly as notwithstanding the Supreme Court's very helpful decision on disparate impact, industry is not thrown in the towel. They're still fighting back on that. I think we need to keep reminding them that disparate impact is not just some statistical aberration that happens, reflecting real discrimination that happens every day.
Thank you both. Next question.
Right. Well, I could probably address that a little bit. So to the extent that a guarantor is collecting a student loan that they acquired before it was troubled, they wouldn't be covered by the Fair Debt Collection Practices Act, but the CFPB does have authority over them if they commit unfair, deceptive, or abusive practices, including debt collection practices. So that's, an important new debt collection authority that they have that the FDC doesn't have. So it wouldn't technically be under the FDCPA. It would be under their unfair, deceptive, abusive authority, but they have the authority to take action against, harassment, threats, misinformation, including about, relief tools that might be available under, federal programs, the education department. So they do have tools against entities other than third-party debt collectors, including in the student loan area.
Thank you, Lauren. And I was very remiss, and I apologize for not recognizing Brad Miller as a congressional liaison at CFPB. Thank you. Yeah.
Congratulations to all of you.
It's an excellent question.
I've thought about this issue almost daily, I can say. And I think one of the most important things that we can do is what we did for the creation of the CFPB and Dodd-Frank, and that is to get consumers involved and keep them engaged. And every day, I'm trying to figure out a way to get more of our followers to know about the CFPB and to know about the good work that they are doing. I know when we were fighting for the creation of the CFPB, we got thousands of people to write to their members to support the creation of it. And now there seems to be a lull. People don't know about the agency. They should know about it. They don't know about the wonderful things the agency does. So I think it's incumbent upon us, and myself included, to be very, very proactive in finding ways to let people know that this agency is here for them and all the great work that they do, be it doing, meetings, conference calls, going out to meet them publicly where they live. We got to do a better job so that when the agency is under attack, either by the industry or Congress, and God knows we've been living in that world for a long time, we have people we can call on to help defend the agency. So.
And if I could just add to that, this administration leaves in a year and a half. This push that Pam's talking about has to be done. It's like Obamacare, ACA, that now that people have it, as time goes on, it's entrenched. So it really is incumbent on all of us to let folks know. I think that we have done a very good job over the past 5 years, but we have 18 more months to really push and push hard. Yeah. I can begin that because I was very much, as everybody at this table was, involved in that fight. And it is the one thing that the Republicans, as you say, Lisa, have tried to do over and over and over, and they will continue to. And yes, if this agency becomes subject to appropriations, it would change what the agency can do. As it was set up, it is not appropriated, which was, I didn't think of it, but whoever did was an absolute genius. And they are going to keep trying to make not one director, but 3 or 4 or whatever. And that goes back to the other question. It's incumbent on us as advocates over the next year and a half to make sure people know about it, because if they don't, it could easily happen. I don't know what is going to happen in the presidential, but I think CFPB is vulnerable and is going to continue to be unless it becomes entrenched.